guys, Josiah here. So I wanted to go ahead and present what I have of this to a select group and open it up for feedback and any questions. And I'm entitling this "How to See the Future" because I think that's essentially what it comes down to. Another way of looking at it is how to take unlimited profits out of any market. And that may sound hyperbolic or, fantastical. But I think it actually does come down to that. And so let me just go ahead and get right into it. And I'll kind of explain what I know and what I don't know as I go along. Things that, problems that I think I've solved, and maybe some areas that are still gray or dim that I don't really understand fully. So the problem when we're looking at investing and trading, the problem is understanding how to know what cheap means, or what in a particular price graph, where is cheap and where is expensive. For instance, in the stock market, you might see, that the stocks have been trending up forever, as long as we have records, with short bouts of downward movement, on different time frames. So, we'll have bear markets for 2 years or something, and then the upward movement will recommence over the next decade or something like that. So, in a graph that continually moves upward, how do you know what's cheap and what's expensive? And there's very few charts of any type of, commodity futures, stocks, indices, gold, silver. There's very few examples of anything that actually just makes a up and down movement where it's easy to see, okay, this is cheap and this is expensive. Most graphs have some measure or manner of trend to them. And I think this is distortion due mostly to the money supply being a fiat currency that everything is denominated in now. Whereas in the past, there would have been more of a tendency for oscillation between two extremes that didn't trend as well. Um, so I think part of this issue is created just due to the fiat monetary system that everything is denominated in currently. But I think in stocks and certain assets, there would have always been a trend as productivity growth existed. As long as the economy was growing, stock prices in general should be growing too. So there would, be some sort of trend there, even if it wasn't as pronounced or as extreme as it is, in our most recent decades. So anyway, this has been the central issue to understanding price movement, that there's no real way to know up and down, or like where cheap is and where expensive is, what's fair, what's not fair, that kind of thing. So the solutions that people have come up with, and let me move this out of the way here, is all the different technical indicators, trend lines, drawings and that kind of thing. But they'll use some basic um, concepts that are made use of in different ways, essentially. So you have oscillators, which are a technical indicator that just tries to quantify the upward movement and compare it to the downward movement and say, okay, this is an extreme of upward movement and this is an extreme of downward movement. And so they try to normalize that upward trend and turn it, into kind of a horizontal movement, so that then you can compare what expensive and what cheap is on that relative space. Um, so that's like an oscillator. You'll have uh, things like moving averages, which in a way are kind of the same thing, because you're with a moving average, you're basically looking to see, okay, is price above the moving average? So that means it's above average. and how far away from that average has it gone? Is it an extreme amount away from the average? Is it close to the average? That kind of thing. So in a way, it's kind of just taking again that trend and putting it relative toward that to that average and seeing how far away from the average it is and how cheap or expensive it is relative to that average. And you can, slice and dice the movement away from the average, that excursion away from the average in many different ways. So one way is with um, well, one way is with average range multiples, like average true range is something that they use. They calculate the average range of each time period over the past X, whatever, and then use that as the building block of distance from the average. So, the average range is maybe $1, and currently price is $3 away from the average. So it's three average ranges away from the average. The standard deviations are another way of quantifying that distance away from the average, how extreme the move is, how extreme the excursion is away from, average, and so thus how expensive or cheap price is relative to that average. Another way that they look at price movements is momentum, speed of movement. So you can see sometimes price tends to, or seems to accelerate and then decelerate and so forth. And so they quantify that in many different ways. And you look for, buying new momentum and selling old momentum, that kind of thing. A lot of like price action type of people look for price breaking above or below a certain the range that price has been trapped in for a certain period of time. If price exits that range, that can be a signal that price might be moving upward, and that this original range is now what you might consider cheap, so it's moving towards something that might be expensive, and so people will hop on board expecting that kind of continuation or whatever. So anyway, the question with all of these is, what settings are you going to use? How many bars of history, how many months of history or how many days of history, minutes of history are you going to use to look at that range? Or what length of time are you going to use for your moving average? How many time periods are you going to use to calculate that? How many time periods are you going to use to calculate the standard deviation or the average range? What settings are you going to use to calculate momentum and so forth? So all of these are, they're all relative to begin with because they're relative to some average or some kind of calculation. And then beyond that, they're all subjective because the settings that you use for each of these individual calculations are all just, you pull them out of the air essentially, or, think through, okay, this makes sense to me, or this doesn't make sense to me, that kind of thing. And so it introduced a lot of randomness. And in any way, in any of these systems, all of them are going to break down at some point. Even if a pattern holds for a little while with one of these indicators, it eventually will break down. And that can be thought of as it's because, okay, maybe on one time frame, the current time frame that we're looking at, maybe it's a daily, daily bars where each bar is a day of time, and so every day we'll look up the chart, and there's a new bar that's appeared for the current day or whatever. And maybe on this particular time frame, price is following this pattern with this particular technical indicator. But on some other time frame, the smaller time frames, you're having individual small bursts of movement and coming back to an average on a smaller time frame. And anyway, so the price is fractal, and so those little cycles are happening on small time frames inside the daily graph that we're looking at or whatever. And on the daily graph that we're looking at, on a monthly graph, at some time frame above us, there might be another cycle that's taking place where the current cycle is playing out as perfectly holding with this technical indicator until we reach a monthly cycle top. And we don't really have any way of quantifying that with our current system, hypothetically here. And so this particular technical system on the daily chart will break down as soon as the monthly or the weekly system takes over. And so price is fractal, and so all these time frames are interacting. The price is moving on all these time frames simultaneously, And so a technical system on one time frame is going to break down when it interacts with the movements of higher time frame traders on a higher time frame. And so all of these systems are going to break down. So I'm here proposing another way of looking at this um, price behavior. And this is the truth as best I know how to currently model it. And so this is not um, a statistical model of the stock market or the different markets. This is not some type of technical system, um, like an oscillator or something like that. It's a perspective or model for viewing the behavior of price on any graph on any asset, and it should be applied to any time frame as well. So the truth that I think I have found here is that price moves in increments, not standard deviations or average true ranges or whatever. It moves in increments relative to the risk of what we're going to call the composite trader. And so you can think of all price movement. Uh, if it's kind of essentially like telling yourself a story. You're looking at a random, something that appears to be a random price graph where there's squiggles and wiggles and everything, and they don't make any sense until you start telling yourself a story about what's going on. And if you start attributing a sort of agency to the market, um, you can view it as the agency of this composite trader, and you can say that the movement of the market, uh, the price of the market, is uh, the composite trader building and uh, distributing positions. And so, if you start explaining the movements of the market in terms of something like this, then you can start trying to understand what that composite trader, that entity, will do next, and what they've already done, and that kind of thing. So if the composite traders, so viewing this way, if the composite trader's position can be analyzed and ascertained, if we can kind of know where they've taken a position and what prices are involved in that, then we can kind of know where price will likely go or gravitate to, or where the composite trader thinks it will be going anyway. And we can know what prices are expensive and cheap relative to that composite trader's position. So if we know what's expensive and cheap, then we'll know how to, rationally buy and sell within that system. So what is a composite trader? The composite trader, I kind of already explained, is it's kind of just my best explanation of an observed phenomenon, which I'll get into more later. But the I wanted to emphasize here that the observed phenomenon is the actual truth here. The CT is kind of a theory or a model of why the observed phenomenon or phenomena are happening. So the composite man, this is actually a concept that was created a long time ago by a guy named Richard Wyckoff, Wyckoff, however you want to pronounce it. I don't actually know the correct pronunciation. The concept here is that you can think of all the individual actions of the millions of different market participants and traders and long-term investors, hedge funds, institutional investors, pension funds, sovereign wealth funds. All this, basically comes out of the wash at the end of the day as a single result or action. And this action is a composite action of all of those individual happenings. And that action can be thought of as the actions of the composite trader or the composite man. So Wyckoff came up with this composite man as a guy that's behind the scenes, pulling the strings, kind of like the guy on The Wizard of Oz. And, so he thought of him as kind of a manipulator. I think of it more as just um, the average actions of all market participants. It's not necessarily something sinister or anything like that. It's just that logically all of the individual actions of all the different people participating have to equate to some average action. And so the composite man is that average, actor. So then we can think of the CT as building a position for himself and then distributing that position. And we can think of, well, who he distributing it to. Well, it's to himself actually, but maybe we'll get into that a little bit later. But uh, so he's theoretically building a position and distributing it back to himself, his alter ego or something where that's taking the short side. And so maybe he buys down here and distributes along the way, builds a position, distributes that position as the price moves up, and finally exits up here where the alter ego of the composite trader that only shorts takes a short position up here and starts the price moving back downward. And so you can think of it as two different people or one person that's just essentially building and then like being taking a heavy position here, heavy net long position here, and then going heavy net short up here. And so on and along the way, there's a point, an average in the middle where they're basically net zero. There's no directional position at all. And so, you can think of it in multiple different ways. They're buying here and selling there, and then selling here and buying there. Or you can think of it as just getting heavy into a position here, lightening up, getting heavy into the opposite position here for a short, lightening up, getting heavy into a long position here, and so forth. So it's in a way the markets are all just uh, how net, net of everything, how net long are you here in this particular moment and how, or how net short you are and so forth. So people, the bigger participants in the market are not taking one static purchase. They're building and growing in increments. And so it's probably best to think of it as, how heavy are you into the position or how light are you into the position at any given moment. So anyway, that's probably the best way to think of this, distributing the position or whatever. But anyway, the the idea is that we can analyze when the CT builds his position and when he distributes that position or lightens up on the position, however you want to see it, and we can analyze where it might be happening, find the break-even point for his position, and with this information, we can calculate a price target where the composite trader will exit the position at a profit. So how could we use that information to find the CT's price target? Well, let me just take this a side trip here for a second and explain this. Um, all trading is going to be subject to the trader's equation, which is also known as expectancy. And this, the formula is here. It's just the percent of profitable trades times the average win size, the amount of money you win on winning trades on average, minus the percent of your trades that are losers times the average loss size, and that's going to equal your expectancy of your system or your sample of trades. Say you take 10 trades, well, you calculate your average, the percent of them that were profitable, and the ones that were profitable, what was your average win? Then you calculate the percent that were not profitable and multiply times the average loss size, and that will give you your expectancy for those particular trades. And so you can kind of get a rough idea. Okay, for every trade I take is worth this much money. So maybe I made $100, but my average for all my trades in the past 50 samples of a sample of 50 trades of my history are on average each trade was worth X dollars, and so that's kind of a way of looking at it. This so this is something that every trader is subject to. And but anyway, so this is an example here. If you win, if you have a coin toss type of a situation where you win 50% of the time and lose 50% of the time, you can still make money as long as you keep your winners bigger than your losers. And it doesn't even have to be this extreme. It could be, it could be $55 versus $50, and so you'd have your $5 expectancy or whatever. Anyway, if you win 50% of the time and lose 50% of the time, you can still make money just by keeping that win larger than your loss. Your average loss needs to be smaller than your average win. And so this means that you should only be taking trades where you're taking profits that are at some higher multiple than your losses. So maybe you want to take profits at 1.5 times your average loss or 2 times your average loss. And so you can kind of, you know, start to build a rational system using this. The only way to build a rational system takes this into account. And so this is how you would calculate whether or not your system is rational or not. So anyway, so this means that if the CT is profitable, and here I'm assuming that they are, and I don't know if that's necessarily the case, but or the best way to view this, but that's the starting assumption I'm making here. But if they are profitable, then they're taking profits at a positive multiple of their risk, and so then we know that they have to be taking profits at greater than 1 to 1, greater than or equal to 1 to 1. So if we already have calculated what the risk is, the maximum amount they can lose, then we can project from that amount of risk, we can, double that, add it to their break even price and find, or take that amount, add it to their break even price and find what a 1 to 1 risk to reward ratio would be and assume that they would exit at that 1 to 1 risk to reward ratio. And if if they're planning to make larger than average profits, then we can um, project a two times their risk unit and find 2 times that, add double the risk amount to the break even point and find 2 times that, and we can expect that they would sell there as well. So this is what that looks like in actual practice on a price graph. So you can see here, this would be a theoretical long position. And so price had, been trending upward. It reached a high and then started pulling back. And so we're in an uptrend, a long term, and price was pulling back in the uptrend temporarily. We didn't know that necessarily at the moment, but this is what ended up happening. And so you can see in this example, if we just assume that as price was falling, somebody had to be buying, because as price is moving, somebody has to be taking one side of all trades. Somebody's always buying and somebody's always selling. Every trade has a buyer and a seller. There's never more buyers than sellers. It's always, it's always the same amount. What really matters is who is basically how panicky or how patient the current people that hold the asset, how patient are they essentially? And so if they're very patient, then price has a tendency to just drift upward toward their target. And if they're very patient or impatient, then price uh, can can manipulate them more easily and take them out of their position and so forth at a loss. But anyway, so you can see here we've got a theoretical, hypothetical, basically 0% break even or 0x break even level. So this is the break even point for the composite trader's position in this example. And down here we have negative 1x. So this is the maximum risk. We're just taking this whole distance here. We're saying this is as far as it went. And so if this is their break even and this is as far as it went, this is the maximum amount of risk they took during this, accumulation phase of this trade when they were buying down here. So this is their risk and this is their reward. So we're just dividing that into basically risk units. We're saying this distance here is their risk unit. One times their risk, or negative 1, since this is a loss, and theoretically they're losing money down here. Is their account or their position is in underwater down here. And then as it starts peaking above this level here, it starts getting into profit and then runs to a full profit here. So this is the buying zone here. and this is where you would hold or adjust the position. Maybe you would start selling small amounts of it as price went up, that kind of thing, and then heavily sell as it reaches the target. But this, you can see again, 0x break-even point. We know the negative 1x distance that it went from there, so we can then take that range and multiply it and add it, to the top of the break-even point here. We can take this range, kind of clone it above here, and then clone it above one more time up here, and so we can see this would be 1 times that range added to their break-even, and this would be 2 times that range added to their break-even. And so then we would expect some selling activity when it hits this 1x point, which we can see happened, at least on a small amount. And then we would expect some selling to happen as it reached the 2x point. And you can see that was perfectly played out as expected there. So just a note, so this is the Composite Trader's risk on this move. And this is down here in the red. The Composite Trader is theoretically, like hypothetically, they would be in a negative, losing money kind of position down here until price started drifting up above their break even. The trade is profitable above this level. And I'll start introducing this. This is, so this would be the profit target where we've projected where we think the Composite Trader will be exiting. And so this whole range can be thought of as the discount area, the place where Composite Trader was buying. The fair value area would be this middle range. And anywhere up here in this green range would be considered premium or expensive. And so selling makes sense up in this area. And so this is kind of like a framework to start understanding all price movements. So this is another view, and this brings up 2 problems though. So how can we know where this 0x break-even point is, and how can we know where, how far down price is going to pull back so that we, will know where this negative 1x point is right here. So if we need to know these 2 points in order to calculate where this point is here and where this point is here. So how can we do that? We'll take the second one first. So how to know when the downward move is over? How do we know how far price is going to fall here? We know it by essentially doing the same thing in reverse. We basically calculate where the short, the short alter ego of the Composite Trader, where they took a position looking for price to go downward. So they sold up here and are expecting to buy back down here. This is, how you think of it. And so if we project how far that alter ego expects price to move, then we can know that price should bottom out in this area here where it did. And so you can see here that this is all reversed. We've got negative 1x here up at the top, 0 break even here. This is near the top here. And then 1x of that range is right here where the price ended up bottoming out. And so in a counter trend, so this is a counter trend. So like I said at the outset, this is an upward trending market on the longer time frame. And so this is a counter trend move in that uptrend. And so since it's a counter trend move, we don't expect it to undo everything that it already did. We're expecting a shallow pullback, not something that completely reverses the trend. And so since this is a counter trend move, we don't expect a full 2x target. We expect only a 1x target. And so you can see that that's exactly what happened here. The CT short break even price is right here. It reached the 1x target right here, 1-to-1 risk to reward ratio. It flirted around with it for a little bit, dropped below one more time, and then started reversing. You could see there was a pullback to it one more time right here before it started running back up. Let me just make sure I didn't miss anything here. So so at this point, we can be confident that, since this 1x target has been reached, we can be confident that the downward move is over, and we could start looking for the long position to be taken as in the previous example over here. Excuse me. So moving on, to the second part of that, which is how do we know where the break-even price is? So now we know how uh, how far down price was likely to go by reversing the whole process. But we need to know where that break-even price is to be able to do either of those. We need to be able to find the long position. We need to know the break-even price for the long CT position, and to be able to find the extent to which price might pull back to where it's likely to stop going down. We need to know the break-even price for the short CT position. So for that, I've zoomed in here. You can see we're still in that short position. We got the 0% or 0x break even, negative 1x up here. So this is the short. And you can see kind of a more detailed view here where I've zoomed in to a smaller time frame. So roughly speaking, when price is ready to reverse on either up or down, it reaches backwards and touches the CT's break-even point. So it tells you itself where the break-even point is. But you have to know the language to understand what it's reaching back for. And so I've tried to make it a little simple here. Break-even points are near certain price structures called breakers, which are quick anti-moves or counter moves in the previous trend. And so I've kind of notated these here, but let me explain. So to make an uptrend, you're going to have higher highs, higher lows, higher highs, higher lows is what you would expect. To make a downtrend, you want lower lows with the lower highs, lower lows, lower highs, lower lows, and zigging, zagging all downward. But you'll notice in these two triangles that I've kind of notated here, we're in an uptrend, but we've got lower low. We've prices turned around and made a lower low, which is the opposite of what we would kind of expect in an uptrend. And so this is the setup for a breaker. So when this makes a low, high, lower low, but then goes above this high, it's considered breaking. This is why it's called a breaker. It's breaking the structure. So we're in an uptrend, we break to a lower low, but then we break back up to a higher high. And so this is kind of like a noisy type of situation where it's not clear what's going on if you're just reading the higher highs and higher lows and so forth. So we're breaking structure, and so this is called a breaker. Um, so these become areas of interest where price likes to reach back and touch in the future. So when you see these, you can kind of say, okay, price will probably interact with these again in the future. And you can see here that there was an area where there were a couple of breakers, and it was a kind of a sideways pause in price before continuing upward here. And then price reached back all the way down with this drastic move and touched the highs of uh, this formation over here. And so what do we look for? So this, you can look at the highs of these two triangles and project those forward as the likely area where price will reach back and interact with in the future. But you can see here it wicked through it. We call it wicks because these are candlesticks. They call them Japanese candlesticks. They look a little bit like a candle. And the wick is the thin part. The base is the thicker part. Excuse me. So you can see we just made a quick wick through on this thin little line here, and then it reversed and went back up. So that's not considered fully acknowledging this level, and so the position is not confirmed yet by my current regime for analyzing these. To find official break-even points, we need to not only find those breakers and see where price wicked and touched them, we need to do one of two things. We need to see either a close of the candle, the individual time frames of each of these candles. The closing price of one of these candles needs to be below this level in this case, or if it were reversed, it would need to be above it. Or the body needs to open below it. A new candle needs to open down here. Or price needs to wick down through it, but then if it doesn't close, then we need to get another lower low wick to wick below that particular wick. So it's like creating this lower low scenario below that level. And so that fully acknowledges the level. And in that case, when we basically put the 0% of break even or 0x break even point at that first wick that was later wicked through here at number 2. You can see here we have number 1 touches, it wicks through the level, comes back up, and then we have it fully broken below here. We break below that wick right there with a new wick, and so we make a lower low, and so that fully confirms this as the interest, the point of interest here. And so this is the 0x or break-even point as I currently read this. So just to recap what we're doing here, we're identifying locations where important breakers are located, which I've outlined here. So we're thinking already, even just after this happens, that price might come back to here later. Then number 2, we're watching for price to reach back and acknowledge the area. And like it did here, it acknowledged it, but it hasn't fully confirmed it. And then we wait for price to pull back to at least a 50% midpoint between the price extreme and the acknowledged break-even point. So we pulled back and reached back and touched it here. We fully acknowledged it here. Then we look for a 50% pullback at least. It's pulled back, and this is the 50% midpoint here between this level and this level. So we look for a 50% pullback at least to acknowledge that this was the point. And that will tell us that we can measure all the ranges from that point. Now, so I mentioned the 2 scenarios, close or open below the level, but we didn't get that here. So instead we had scenario number 2, which is the level is wicked through, and then that wick is actually wicked through right there in number 2. And so that confirms it as an alternate way of doing that. Some other clues that you're interacting with the level are this type of behavior right here, where it's kind of touched and then purged through right here. It's like it tries once and then tries again and finally accomplishes it before reversing. So this is something you can look for, and you can see it actually happened on a smaller time frame here. You had kind of a downward move, upward move, then further down right here. This, if you just ignore this wick, if you were just looking at the candle bodies or the bases here, you can see it moved down, then moved back up, then moved down, purging that level before reversing. And so this was kind of a smaller time frame of the same happening of the same thing. And here you can see that actually the same thing is happening on a larger time frame as well. You've got the same behavior where you push down, can't quite do it, then push down again and can do it. You get that wick below the other wick, confirming the lower low, and then it reverses from there. And so it's kind of the same behavior, but on a larger scale. So that's kind of a clue when you're looking at an important level. Look for that kind of interaction with the level. So after touching the break-even price needs to pull back to at least the 50% midpoint, as we've talked about. So you can see here, after touching it here, it pulled back to 50%, but it hadn't fully acknowledged this level. And so this is not the place where I would want to be getting in short here. You would wait until it fully acknowledged the level here, then pulled back to 50%. And this would be an ideal time to actually enter a trade short, expecting price to go downward. So then we get into projecting the target. Since now we know where this point is, and we know where the maximum risk point is here, the distance between those two is the range. And thus we can project 1 times that range and 2 times that range down here. Now in this case, this is the counter trend move, and so we're only concerned about the 1x target right here, and so it was achieved at this point right here. If it were a with trend move, then we would expect a full 2x target. So this is a side note about the fractal nature of price movement, and I've already mentioned that a little bit, but price behavior is fractal, meaning that the same patterns are recurring each individual tick, or they call them ticks, but each individual trade is basically non-jargon way of saying it. Each individual trade, uh, this kind of thing is happening. So, you can have three trades in a row, and one would be at the max risk, one would be at the break even, and so forth. So this can happen at, the tick by tick, trade by trade level, or it can happen on a second by second, minute by minute, hour by hour, day by day, month by month, week by week, whatever. It's happening on all time frames, is what I'm trying to say. And so the CT is operating on all these time frames simultaneously, because the CT is just the market. We're just ascribing agency to the market and saying and trying to interpret the market's actions in terms of some entity that has agency. And so since the CT is operating on all these time frames, they're accumulating small amounts on the small time frames and distributing small amounts, on the small time frames as, these tiny zigs and zags. But those become bigger waves just like on the ocean. And so they're accumulating large positions down here on a slightly larger position or larger time frame and distributing those larger positions on, this larger time frame. And they're building huge positions, on even a higher time frame and distributing those huge positions on the higher time frame at higher prices. And so these zigs and zags are just, accumulation, distribution, accumulation, distribution, accumulation, distribution that all net out to accumulation and then distribution. And those zigs and zags all net out to accumulation, and then distribution of a large position at a higher price. And so this is what uh, these the ebbs and flows that all net out to the particular action of the market. So knowing this, we can analyze the CT's risk, break-even price, and price targets on all these different time frames. And so this can be as low as tick by tick, 1 minute price charts, or monthly price charts where each bar is 1 month. So it doesn't really matter. And there is some more to this phenomenon that I found. You probably noticed there were some extra lines between the different ranges that I noted. The uh, discount, the fair value, and the premium levels. Inside those ranges, there were some additional lines on the previous charts, and that's because due to the fractal nature of these price movements, every 1/3 of this total range, you divide it into thirds, the discount, fair value, and premium. And each of those thirds can be further subdivided into its own thirds. And each of those can be subdivided into their own thirds, and so forth, all the way down to the individual ticks. And in reverse, you can multiply it, each range actually is its own third as well. So that range is the lower third of another range, and that range is the lower third of another range, and so forth. So you can both divide by thirds and multiply by thirds all the way up or all the way down. So the meaning of the thirds, though, I think is maybe the insight here, and that is that the lower third is the discount cheap zone on that particular time frame. Like I said, these zones are forming on all time frames. So there's cheap on the tick by tick level that might be in the expensive zone on a month by month level. It's all relative to what time frame you're on. The middle, so discount cheap zone at the bottom, middle is fair value, and the top third is the premium or expensive zone. So you kind of, from this, where to buy and sell on that particular time frame. And so this again is just a look at that model. We've got the lower area right here, middle fair value. You want to be buying down here where the composite trader is buying. You want to be holding here or maybe adding to your position down in this area and then start distributing small amounts up in this area, something like that. And then as you get up into the upper expensive area, you start unloading your position or holding out for the final target up here. But you can see here that this is what I mean about the fractal nature of markets. So each of these this range is divided into thirds, but each of those thirds can be divided into their own set of thirds. And each of those thirds can be further divided into their own set of thirds. and so forth all the way down, and so forth all the way up, because this range here, set of three, is actually just, again, this green area on a larger time frame. And so this is the kind of a key insight as well. Once we know where the break-even price of the markets, see the composite trader is, and where the maximum risk is, we can then take a measurement, and this measurement applies to multiple time frames. So we can say, okay, on the 1 minute, we're getting expensive here. I'll hold off and wait for a pullback into the disc or the fair value or the discount area down here, and then price, as you buy a small amount here, buy more as we exit the deep discount here, and maybe sell some here, buy some back in here, price moves up, you come back down on a longer time frame, you're buying in this green zone here, holding for a longer target up here, and so forth. So you would get really heavy down in this area for a longer time frame. You get heavy on a shorter time frame, like if you're on a minute by minute, maybe you're only trading 10 shares or 100 shares here, and maybe on this kind of time frame you're trading 1,000 shares, and maybe on this time frame you're trading 10,000 shares or something like that. And so you can build and grow that position and then distribute that position with these levels in mind. In addition to the thirds, there are halves, and I don't know exactly how important the halves are, but each of these ranges has a 50% half or midpoint, which is you'll often see that price interacts with those levels. But I think there's an important distinction here in that the half ranges are not, you can't divide them and multiply them the same way as the thirds. I think the thirds are the only ranges that you consider proper building blocks for price action and for understanding future price action. So a proper full range can be subdivided by 3, multiplied by 3 as needed, and ad infinitum for smaller and larger time frames. But halves, you can't do the same thing for. And I actually even question whether there's much significance to the half point, because you'll notice that you might think of it as like an average or a median of the particular position for this time frame or whatever for the CT. But a lot of times you'll actually see that when price comes back and interacts with a half point, if you zoom into a smaller time frame, you'll see that it's actually just interacting with a lower third, a discount or a premium on the lower time frame. If you really zoom in and expand it, you can see the lower the midpoint actually was that it was interacting with was actually just a third on the other time frame. So I'm not sure about that. I think on a macro sense, they're important to know about, but maybe not as important as people think they are. So just keep that in mind. Anyway, so just a quick recap. If we want to earn capital gains in the markets, we need to know what is cheap and what is expensive, so we'll know where to buy and sell. And so this gives us kind of a model of what cheap and expensive are. To know what it is, we read the market's own behavior, interpreted through the actions of the composite trader, ascribing a sort of agency to the market. And when the CT accumulates, we look for his break-even price and try to buy at or below that point. That's that lower third. Likewise, when CT distributes, we look to sell at or beyond 1 times his risk, his original risk, down in the lower third. We add that lower third size to his break-even point and get our projected target for a countertrend trade, or 2 of those ranges to the break-even point for a with trend trade. So these multiples become the framework through which the market can be understood and traded on any time frame. Now, I hope this has been interesting. I'm going to do more about this, but I wanted to do a quick presentation, and maybe this is not very quick, but I wanted to do a presentation to get this out so that anybody, I don't think I've ever heard of anyone talking about the markets in these terms, and so I wanted to get this information out there and recorded and put down so that that it's available no matter what happens in the future. So anyway, I hope this has been beneficial, and I will talk more later.